common type of active management is a mutual fund. A mutual fund is run by a company, an investment company. Then the mutual fund is run by a fund manager, and the fund manager picks a portfolio of different investments for the investors in the fund. So there are multiple investors, obviously, in a mutual fund. They put their money into the portfolio. The portfolio manager picks the investments. The portfolio manager may run it very actively, in which case he's trying to beat the market and he may buy and sell securities quite frequently, or he may run it more passively and only sell securities in and out of the portfolio in a very slow manner. The mutual fund has some details that are very important to you to understand, which will impact your returns. The first is taxes. Most investors invest in mutual funds through their IRA or 401k, which means your taxes are deferred. There are no taxes on the trading in the portfolio. So a mutual fund manager who has a portfolio and they think the investors are not concerned about taxes can move in and out of investments very quickly. And this is true for your own portfolio. If you're running your own portfolio and it's in an IRA or a 401k and you want to get out of something, there are no tax consequences. If it's not in a 401k or IRA or a tax deferred account, then there are tax consequences. And tax consequences make a definite difference in your returns on the portfolio. So think about your decisions in tax deferred and taxed accounts as being different. In tax deferred accounts, it's very easy to get in and get out. In taxable accounts, where you're going to have to pay taxes on your profits, if you've had a long-term capital gain on a stock that's run up quite a bit, it may be difficult to jump out of that stock because of the tax consequences. You could be paying 15, 20 or more % in capital gains taxes on those long-term investments. So taxes are a concern for mutual funds. Many investors have not recognized that even though they didn't sell the mutual fund can throw off taxes to you that you have to pay because the portfolio manager is picking your investments, but you actually own the investments. So if they get rid of 2 stocks and buy 2 more, the 2 stocks that they sold, if they had taxable gains on them, those taxes aren't passed to the mutual fund manager, they're passed to the investors. And so if you buy a mutual fund, it's very common in a non-tax deferred account to find a tax bill at the end of the year. So when you think of mutual funds, remember your taxes are a crucial part of the income or the return on the mutual fund. Also, there's fees. You're paying the investment company and the mutual fund manager a fee for picking these stocks for you, and that fee is, it can range from almost nothing in some particular investment companies to quite large. You could be paying a commission and a fee of 4, 5, 6% just to get into a mutual fund. So you have to be careful and watch the fees, as they're definitely going to impact your return. So taxes and fees are a big part of mutual fund investing. So you have to watch the taxes and watch the fees. Now, if you combine the taxes and the fees to the fact that most active mutual fund managers don't beat the benchmark. So this example is if the benchmark was the S&P 500, which is the whole portfolio they could choose stocks from, and they're trying to pick winners in the S&P 500 and avoid losers. If they don't beat the benchmark and that you have to pay them taxes and fees in addition to not beating the benchmark, then you're obviously not gaining money, you're losing money compared to just holding the S&P 500 into a passive or index fund. An index fund would hold the entire portfolio. The active manager or the mutual fund manager would hold specific parts of the portfolio that he thought were going to succeed or be successful and go up in value. So a mutual fund investment has several components that you need to be aware of. One of which is taxes. If it's in a tax-deferred account, this doesn't impact you. If it's not in a tax-deferred account, this can definitely impact you. It can be quite a surprise. The second thing is you're paying a fee to the fund manager. So the fee is going to reduce your returns on the portfolio. Some fees for, quote, loaded mutual funds, funds that have commissions based on them, can be quite excessive, 4 or 5%. I mean, it's not unusual to see a front-end loaded fee of 4 or 5%. So you have to be very careful when you invest in mutual funds to find out what the fees are. In addition to that, you're buying active management. In other words, you're making a bet in a mutual fund that the investment manager is going to do better than the index, than the passive investment of an index fund. So you're making a bet on the performance of that particular individual. So it's important you know they're very good at what they do, because if they don't beat the benchmark, you're paying fees and potentially taxes to the investment company, and you're not beating an index fund, which would have lower fees and lower taxes. So it's very important when you think of mutual funds not to think of them as just a way to diversify your investments. And they certainly do diversify. Mutual funds don't typically hold more than a few percent in any particular investment. So they do have broadly diversified portfolios. However, they have taxes and fees, and their active management often does not beat the benchmark of just investing in an index fund. So mutual funds are good investments. They are usually solid choices for people in their 401k and their IRA and so on. But it's often better to invest in a passive way in an index fund than trying to beat the benchmark after paying taxes and fees. So think about that when you're investing in mutual funds.